back, class. I want to apologize because I did this video earlier and I thought that it was in the process of getting it closed captions on YouTube. Never did, but apparently it was because the sound did not work. So hopefully this one will come out correctly, and I want to go through the Chapter 9 content rather quickly here to give you an overview of what's here. So we're going to start with capital decision making and looking at project cash flows. And if we're going to do that, we're only looking at relevant cash flows, which are the same thing as incremental cash flows. Incremental cash flows are only the cash flows that are related to the project specifically and not to the corporation overall. So if we're taking on a project, we want to analyze it in the light of that project alone. We don't want to include any analysis of anything else that's already there. That means that the project stands alone, and we're just going to analyze that as if it were an entity to itself. Now, this means that there are some things we have to avoid, like we don't want to consider sunk costs. And a sunk cost is something that the corporation already has, that it's already paid for, or that it's already obligated to do. So if you had a building that you were thinking about using for maybe the construction of a new product line, the cost of that building is a sunk cost. You don't really have any costs in that building. It's already there. So it's using anything the company already has. An opportunity cost is also something we don't want to deal with, because an opportunity cost represents something we could do with the asset that's different. So if I think about the building again, if we rented it out, we could earn some extra money. That's an opportunity cost. We're giving up the opportunity to rent that out in order to make this product. Another thing that we don't want to think about really here is erosion or side effects. What that means is if we have one product line and we introduce a new one, that product line may take sales away from an existing line. And then net working capital will change over time, and in this case we don't want to really look at that as a contribution. Well, it's not going to be a part of the cash flow. Financing costs as well. Those are not going to be anything that we want to consider in this analysis either. We may finance it, but that's really a part of contributing working capital to the project. So we're going to start with pro forma financial statements, and this really relates to the details around the project itself. Pro formas are really where we take the information they give us and create an income statement. So in this case, they're telling us we're going to make Shark Attractant. I don't know who'd want to buy it, but we're going to make it evidently, and it's going to cost $4 a can. Well, we're going to sell it for $4 a can, and it'll cost us $2.50 to make. So the product has only a 3-year lifespan, and they make a note here, probably because the customer base dwindles rapidly for those who use it. So we need a 20% return on any new product. So we're going to calculate the cost of these products that we're going to make after we understand exactly all the details. So we're going to have $12,000 a year in fixed costs. That's the rent on the building. We'll need to invest a total of $90,000 in manufacturing equipment, and we're going to assume that it'll be 100% depreciated over the 3-year life of the project. And then the cost of removing the equipment will be roughly equal to its actual value in 3 years, so it'll be worthless. And then finally, the project will require a $20,000 investment in net working capital, and the tax rate's 34%. So we do this pro forma here, where we take the sales that we've projected of 50,000 units and calculate sales over the course of the project life of 200,000. We take the number of units times the cost needed to manufacture those at $250 each. We get 125,000, so we have gross profit of 75,000, fixed costs of 12,000, depreciation of 30,000. And that means we have earnings before interest and taxes of $33,000, and then taxes out of that of $11,220, with a net income of $21,780. Now that's an income statement. That's not a cash flow statement. When we're talking about what we have to do, we're also going to look at the projected capital requirements. What are we going to have to put into this to get it off the ground? $20,000 in net working capital, and $90,000 in fixed assets for a total of $110,000 in year 1. We'll still have the $20,000 invested in it in year 2, 3, 1, 2, and 3. And then we'll also have this fixed asset value in it that's going to be reducing over the course of the life of the project. So in the first year, 1/3 of the asset will go away to depreciation. We'll have a book value then of 60, a book value in year 2 of 30, and then a book value of 0 in year 3. So the total investment in the project for each of the years is shown here. Now we want to do a project cash flow. And if we're going to do this, we're going to start with the income statement that we had back here, the pro forma. We're going to start with the earnings before interest and taxes and add back depreciation, because depreciation is not a tax or not a cash-based expense. It is a non-cash expense. So we add that back because it has no impact on our cash flow. Taxes, we're going to show that deduction because that does have an impact on cash flow. So our operating cash flow from this basic product here in the first year, or the year that we're looking at, is $51,780. Now, we also are going to project the working capital and capital spending. So when we talk about how we actually put money into this and what money comes in, we're going to look at this overall cash flow. We start with a negative cash flow in the operating, the beginning of the project of $110,000, split between the equipment of $90,000 and the change in net working capital of $20,000. In year 1, we have the $51,780 in cash flows that comes back. Year 2, the same amount, and in year 3, we recover the $20,000 in net working capital we initially invested, plus this additional cash flow that we have based on the net income statement, and that basically gives us $71,780. Now we want to do a net present value for that, so we calculate it like this. The initial outlay is a negative. We're going to bring in $51,780 the first year, divided by 1 plus the required rate of return of 20%. Year 2, the same thing, divided by the 1 plus required return rate of 20% raised to the second power. And year 3, the cash inflow goes to $71,780 over 1 plus the required rate of return raised to the third power. All told, the net present value of the project is $10,648. And since it's over $10,000, and that's our criteria, we should accept the project. We should engage into it. And what this really means is, when this is positive, it means that our rate of return is actually over the 20%. In fact, they show here that after some trial and error, the internal rate of return works out to be about 25.8%. So we could also calculate payback period of 2.1 years, although that's really questionable as to how valuable that calculation is. And then the average accounting return is actually calculated to be 33.51%. And that really demonstrates how far out it is from the internal rate of return, and probably how it's not an accurate reading of what the return rate is on the project. When we look at a tax shield approach, what we're actually doing is we're calculating the operating cash flow and adding back in the benefits we recognize when we deduct depreciation. So we take the operating cash flow and multiply it by 1 minus the corporate tax rate to get the amount of cash we have after paying taxes. To show or add back the benefit from depreciation, we take the $30,000 times the tax rate and add that back to what we had here. And then we bring in this, which is actually $10,200. So when we take this amount, $200,000 minus 137 times 66%, we get $41,580. We add back $10,200 and we get $51,780. This is the same amount we calculated up above in the when we calculated the cash flow. So when we talk about cash flow, we are using net working capital to fund the project. And here they're showing another project. We have a very simple income statement, very simple balance sheet. We only have two items on the balance sheet. Assets are accounts receivable, liabilities are accounts payable. And you see both of them increasing over the course of the year. The assets, accounts receivable, increased by 30, and then the accounts payable increased by 55. The difference between the two is the net working capital, which is a reduction of $25. Now what this is this is a change in net working capital, but the change in net working capital is exactly the opposite of the cash flow that's assumed here. So if we were doing a statement of cash flows, we would do a similar calculation, but when assets increase, it's a decrease in cash flow, and when liabilities increase, it's an increase in cash flow. So the way this would work is we would actually have an increase in cash flow from this of 25. Now, if we want to look at the total cash flow, that's going to involve this. We're going to have net income of 190, and we're going to show that here. We'll show the net income of 190. We're going to add in the 25, or we're going to subtract out a negative 25, which is adding it. So we get $215. Now we know that income, or that's cash flow that we're calculating, total cash flow. All right, depreciation is fairly straightforward to calculate. When we look at this, we're looking at it through the eyes of the IRS. When we use the modified accelerated cost recovery system, which has three property classes, 3-year, 5-year, and 7-year, and it uses these assets fall into those categories. When you look at how you depreciate it, they give you a set table, and you have a percentage of the cost of the asset you're allowed to deduct in each year as depreciation. So if we have an example here of a car we purchased for $12,000, we show the depreciation calculations here for each of the years we have it. And you notice at the end of the period we've depreciated the entire vehicle of $12,000. Now, when we think about book value and market value, we're going to talk about two different things. We have a book value here, and we're showing that decrease every year because we're taking depreciation out. Market value may not match that. So let's suppose that in year 5 we sell the vehicle for $3,000, and we have a book value of $691.20. Selling it for $3 with a book value of $691.20 means that we have $2,308.80 in depreciation that is recaptured, or that we've claimed too much depreciation. This is not a capital gain. This is basically a recovery of prior depreciation deducted in our taxes that we need to, again, pay back, or basically recognize that needs to be added back in. So what we're going to do is we're going to take 34% of that, since it's our tax rate. We wind up with $784.99 in taxes that need to be included or recaptured because we depreciated too much on the car, and then when we sold it, we still had value in it. And that's not a tax on capital gain or a gain, even though technically it's a gain in accounting terms. Underneath the IRS code, it would be considered a recapture of depreciation. Now, it can happen the opposite way too. And here they have an example of one where they have computer equipment that they've acquired for $160,000, and they depreciate it over 5 years, so that they get down here to year 4 and they decide to sell the equipment. They have a book value on the asset of $27,648. They sell it for $10,000 at that time, so they have a loss of $17,648 for tax purposes. The loss, what that is depreciation, because it's not a cash expense, but what that means is we didn't depreciate this quickly enough, it lost value more quickly than we anticipated. So we get the $10,000 cash from the buyer. We do have this loss because of the book value. But when we talk about cash flow, we get $10,000 in cash from the buyer. And second, we're going to save some money on our taxes by taking the tax rate for our business times that loss. So we save $6,000 in taxes. So in that case, the after-tax cash flow is $16,000 because we're adding back the 10 and adding back the savings we have in taxes. Here's a case where we're going to go through some analysis with some more capital budgeting calculations for the Majestic Mulch and Compost Company. We're going to make some automated composting equipment, and these are the projected sales figures for the 8 years of the project. We assume that we're going to sell this at $120 a unit when we start out, and then after a few years we're going to drop the price to $110 because we'll have more competition. We have some other facts. The variable cost per unit is $60. Fixed costs are $25 a year, and the required rate of and the net working capital that's needed at the end of each year will be about 15% of sales for the year. It'll cost $800,000 to buy the equipment. It's industrial equipment and qualifies as 7 years backers property. It'll be actually worth about 20% of its cost in 8 years, or $160,000. The relevant tax rate is 34%, and the required rate of return is 15%. Based on that information, we're going to calculate whether we should go forward or not. So here we project out revenues. Notice we take the unit price in each of the years times the number of units that we anticipate to sell. Next, we calculate depreciation on the $800,000 worth of equipment using a 7-year depreciation, and we're going to use the Macker's percentages here to calculate what that depreciation is each year. And then we're going to prepare pro forma financial statements or income statements looking at this project. We say here with a unit price of $120 and unit sales of $3,000, we have revenues of $360 in the first year, variable costs of $180, and fixed costs of $25,000 with depreciation of $114,320. Earnings before interest and taxes are $40,680, and then taxes come out, and that leaves us with net income. We do that for each of the years, and we're going to calculate out the 8-year life of the project. We're going to calculate the net income in each of those years. We're also going to look at the changes in net working capital. So we have net working capital here in year 0 is $20,000. 15% of sales, we have to increase it up to $54,000. So we have additional cash outflow. 15% of sales, we've got to bump it up to $90,000, so we add additional $36,000 in cash flow. That's coming out of the company going into the project. Then revenues jump to $720,000, so we have to bump it up again to $18,000 by $18,000 to get to $108,000. Then in year 4, we start to see a decline in the requirements of net working capital because the sales are beginning to decline. You notice it peaks here, but it starts to decline again. So then what you're seeing over here is a positive cash flow because some of that net working capital is coming back. It's a repayment of net working capital from the project to the corporation. So how does our projected cash flow look for this? Well, we start with the earnings before interest and taxes in each of these years. We calculated that up here. And so we're going to go from these in earnings before interest and taxes, EBIT, and we're going to take that and we're going to calculate how much cash flow we have by adding back depreciation and subtracting out taxes. You see the operating cash flows here, and then we're going to show the cash flow related to net working capital and what it is here. This is the changes in net working capital. And all told, we're going to have capital spending here of $105,600. So we've done all of that. We've calculated the long-term capital invested in the project, and then we're going to calculate these projected total cash flows based on the operating cash flow we calculated up here, right here, and we're going to take out or account for the changes in net working capital here, and then we're going to show a cumulative cash flow here. So you'll notice in the first year we have a rather large negative cash flow because you can't see it, the book is not showing it well, but in year 0 we have this large outlay of $20,000 and $800,000 or $820,000. So then as you begin to have cash flow, you are reducing the amount of negative cash outlay you have, and you start coming into a positive number in year 5, and in year 8 you see you have a total positive cumulative cash flow of $808,500. So that's how we analyze that. And then, of course, when we're talking about discounted cash flows, we always want to look at the net present value, and we're looking for a positive number. If it's a positive number, we might go ahead with the project, but really it probably means we want to analyze it a little more to see if we want to go with a project. We also want to forecast risk, or we also want to consider forecasting risk. The risk that we have in forecasting is that our forecasting numbers are way off or wrong or not correct at all. And if that's the case, as they say here, your decision making may be garbage in, garbage out if you don't really have good information. So there is some forecasting risk built in just because you're estimating. You don't really know what's going to happen. And then so there are times when it does go wrong, and they talk about that here. And there are cases where your estimates are off and you have to make an adjustment for it. Okay, so what we do in finance many times is do scenarios and what-if analysis. And if we do what-if analyses, we're basically looking at multiple options per project. So we may have, in this case, a base that we're starting at. We think this is a good number. It could be as low as this in production and sales. It could be as high as this. But we want to analyze all 3 possible cases to see what they're like. So if we're looking at this, we can calculate the base case right here. We're going to sell that many units at $80 a unit, so we calculate all this out. The sales, the cost, fixed costs, depreciation, earnings before interest and taxes, and then net income. So if we look at that, we have operating cash flow, because we're going to add back some things. We're going to add back the $40,000 in depreciation. We're going to subtract out the $10,200 in taxes. So we actually have operating cash flow of $59,820 or $800 a year. And at 12%, the 5-year annuity factor is 3.6048. So we calculate this to be the base case net present value. We come out with a positive number of $15,566. That means that the project looks pretty good. So far it does. But we could analyze these other scenarios to see what would happen in those cases. And so when we look at this, we're going to do a calculation, a side-by-side comparison of the net income in the base case and the cash flow and the net present value and the internal rate of return. Notice the worst case is only 500 units less, but we have a net loss in income. We have cash flows of $24,490. We have negative present value and negative internal rate of return. The only reason we have a positive cash flow here is because the loss provides a credit on our taxes, and we benefit from that because we can count that as a cash flow. In the best case scenario, we have quite a different scenario play out. So you'll see that in the base case and the best case scenario, we have very strong positive net present value and internal rate of return. But just a little bit of change down to 500 units less creates a negative net present value. What that means is, in the worst case scenario, this does not meet our required rate of return, and it may be that we look at our projections and decide this is not really worth, not necessarily worth the effort into it. It might be, but it might not be. When we talk about sensitivity analysis, what we're looking at is where might the forecasting risk be severe. So in this case, when we're talking about the severeness of forecasting risk, we would look here and see in this net present value how much change there is in this worst case scenario from the base and the best. So again, you're looking at this basically to find out where the sensitivity is. Now, if we do the sensitivity analysis and graphically put this out and show these items on a graph, we'll see the best case scenario is way up here at 39,357 net present value. Base case here, and worst case is negative 8,226. So, by way of comparison, we now freeze everything except fixed costs and repeat the analysis. So in this case, what we see here is, given the ranges, the estimated net present value of the project is more sensitive to projected unit sales than it is to projected fixed costs. In fact, the worst case for fixed costs, the net present value is still positive. So what they're saying here is that there are sensitivities in there are elements of the calculation that cause this number to be negative or impact it more than others. All right, now when we talk about other considerations in capital budgeting, there's always a lot of managerial options and decisions that work into this. Contingency planning, or what-if procedures. What if we engage in this project and we have some options along the way? We may also look at this project as a what-if, from 3 options. We could expand the project as we go into the future. We could abandon the project if it gets too rough in the future, or we could also wait to do the project if we think that the timing is off. In the beginning of the chapter, they talked about Euro Disney and the difficulty that Disney had in France compared to other places in the world. Oh, no, it's right here. I'm sorry. I thought it was the beginning of the chapter. This is an example. They look at this as an ongoing basis and they say, do we want to abandon the project or pull the plug on it, or do we want to make the changes we need to and make it successful? Strategic options are basically decisions that are made related to business moves. Projects create these options and may be very valuable, but it's hard to measure. And then capital rationing occurs when we have profitable, positive net present value on a project, but we don't have the resources to do that project. So we may have a certain fixed number of assets available to put into a project, but many of those may be dedicated elsewhere. We may not be able to put those in the project we want. The situation we are describing here is soft rationing. That means we ration the money available for the projects to different places. We may have a problem with sales in other places if we're doing that, or we may have other issues in the company. Hard rationing is when you cannot raise capital for a project under any circumstances. So that means that there's something probably amiss in the business itself. But anyway, under hard rationing, you're not going to be able to do any of the project. Okay? So I'm going to go down here to the critical thinking and talk about what you need to do here. First, we have opportunity cost. In the context of capital budgeting, what is that? I talked about it some here, but it's also in the chapter. And then depreciation, if you had a choice, would you rather use MACRS or straight line depreciation, and why? And MACRS, by the way, is accelerated cost recovery, and it's accelerated because you're basically taking more of the depreciation up front. And then we get to the questions and problems. We're going to do number 1, where we look at this company that bought land in anticipation of using it, and they want you to analyze this project. And then we're going to move down here to number 3, where we do calculating a projected net income. This is basically producing a pro forma financial statement, a pro forma net income statement based on a project that they're talking about. And again, you want to compute variable costs, fixed costs, depreciation. So basically your job here is to do what they did up above in some of the examples in the chapter. And then in number 5, you need to calculate depreciation for newly purchased equipment that costs $715,000 and is classified as 7-year property under MACRS. So you're going to use the MACRS schedule to calculate the depreciation. And finally, number 20, you have a project. They want you to calculate project cash flows and net present value. And this is going to require that you do the pro forma financials income statement like we did up above, where you calculate net income, and then you also calculate projected cash flows and net present value. So that's the homework. And again, I apologize for the lateness of this video, but this was my mistake with the sound not being on. But anyway, many blessings. Hope you have a great weekend, and look forward to seeing your work.